The financial crash of 2008 is often remembered as a distant event. A moment in history that many assume belongs in textbooks or old news footage, yet its impact continues to shape the lives of millions of people across the United Kingdom, influencing the way banks lend, how families plan their budgets, how homeownership is approached, and how employment and wages are structured. While headlines may have moved on, the policies, mistakes, and decisions of that year still govern everyday life in Britain, and understanding their legacy is essential to comprehending why so many ordinary people struggle despite the appearance of economic recovery. Number 1. The boom before the bust. The years before the crash were years of confidence, almost euphoria, across Britain. On the surface, the economy seemed unstoppable. Housing markets were booming, lending was easy, and consumer spending surged. Every new mortgage, every rising house price, reinforced the belief that growth was permanent, that wealth could be built on a rising tide of property values. Families felt secure, banks reported profits, and investors celebrated increasingly complex financial products as marks of ingenuity rather than risk. Yet underneath this apparent prosperity, the foundations were fragile. Lenders extended credit with minimal scrutiny, offering mortgages to households whose long-term capacity to repay was uncertain. Financial institutions repackaged these loans into securities that seemed solid on paper, but whose stability depended entirely on the continuation of rising house prices. Risk was hidden behind layers of complexity, obscured by confidence and the momentum of an expanding market. For ordinary citizens, the signals of danger were invisible. House prices were climbing every year, banks assured them that borrowing was safe, and the prevailing narrative was that owning a home was not just achievable but inevitable. Wealth felt attainable through leverage, and the idea of decline seemed impossible. People did not question the system because the system appeared to reward them at every step. In hindsight, the boom before the bust was a mirror of human optimism meeting structural fragility. It was a period where belief in growth masked vulnerability, where success on paper created a false sense of security in real life. The stage was set not for a gentle correction, but for a shock that would ripple through families, institutions, and the economy itself, revealing the consequences of building stability on a foundation that could not bear the weight of its own promises. The excitement, the optimism, the apparent certainty, all of it was the calm before a storm that would reshape Britain's financial landscape for years to come. Number 2. The collapse that hits the UK. When the tremors from the American housing crisis reached Britain, the illusion of stability crumbled almost instantly. The banking sector, long celebrated for its resilience, revealed deep vulnerabilities. Northern Rock, once a symbol of secure lending, became the epicenter of panic as depositors lined up to withdraw their savings. Television screens and newspapers broadcast images of queues outside bank branches, and a collective unease settled over the country. People realized that financial security was far more fragile than they had believed. The crisis spread quickly. Other major banks faced liquidity problems, pension funds lost value, and investments once considered reliable plummeted. Jobs were lost, bonuses evaporated, and households that had taken on debt in confidence suddenly confronted the stark reality of a market in collapse. Families who had believed in steady growth now faced the uncomfortable truth that prosperity was neither guaranteed nor permanent. Government intervention was swift, but the focus was on shoring up the institutions that supported the economy rather than directly protecting citizens. Emergency bailouts injected liquidity into banks and reassured markets, but the effects on ordinary people were immediate and enduring. Lending standards tightened dramatically. Mortgages that had once been attainable with modest deposits became far harder to secure. Savings lost value. Anxiety over financial stability became a daily companion in many households, altering behavior, decisions, and even long-term life plans. The collapse was more than a financial event, it was a psychological one. The confidence that had sustained consumer spending and market growth gave way to caution and skepticism. Britain, long proud of its measured approach to banking and finance, now confronted a reality in which even the most carefully constructed economic systems could falter. The echoes of this period are still felt today, shaping attitudes toward debt, investment, and the very notion of security in ways that continue to influence both policy and daily life. This was the moment when prosperity, long assumed to be unshakable, was revealed to be a delicate construct, dependent on confidence as much as capital. Number 3. Banks reinvent risk. The aftermath of the financial crash forced British banks to confront the fragility of the systems they had long taken for granted. The era of easy credit and rapid mortgage approval came to an abrupt end. Institutions that had once competed to extend lending now pivoted sharply towards self-preservation, scrutinizing every application with a level of caution that was unprecedented. The logic was simple: stability had to come first, and the mistakes of the past could not be repeated. For ordinary people, the change was profound. First-time buyers discovered that the path to homeownership had narrowed dramatically. Lenders demanded extensive documentation of income, proof of savings, and spotless credit histories. Deposits that once felt manageable now became significant barriers. The process, once routine for many, turned into a careful negotiation with the system itself. Banks, while restoring confidence in the market, had unintentionally erected invisible walls between young families and the property ladder. The scrutiny extended beyond mortgages. Loans of all kinds were re-evaluated through a lens of extreme caution. Interest rates, fees, and repayment terms were no longer matters of convenience but instruments of risk control. Every transaction became a question of whether the borrower could withstand potential economic shocks, not just whether they had immediate ability to pay. Banks shifted from facilitators of growth to gatekeepers of security. The ripple effects reached far beyond the financial sector. Housing markets stagnated in places where demand had once been insatiable. Families postponed major life decisions, moving to a bigger home, starting a family, or investing in new opportunities, because the financial landscape no longer felt predictable. The cultural assumption that homeownership was achievable with hard work and prudent planning was challenged. In the years since, this cautious approach has become embedded in the banking system. Risk is no longer theoretical, it is a daily consideration that governs policy, lending, and strategy. For millions of Britons, the legacy is a quieter, more deliberate economy. Growth remains possible, but always tempered by vigilance. Security has been prioritized over aspiration, and navigating this transformed financial world has become a test of patience, planning, and persistence. The lesson is clear: in a post-crash Britain, stability came at a cost, and that cost is measured in the hopes, timelines, and life plans of an entire generation. Number 4. Cheap money and rising property prices. In the years following the financial crash, the Bank of England took decisive action to revive a fragile economy, lowering interest rates to levels never seen before in modern history. On paper, this was meant to stimulate growth, encourage borrowing, and reinvigorate the property market. For investors and large corporations, it worked. Cheap money opened the doors to aggressive speculation, creating a climate in which real estate became less about shelter and more about rapid financial gain. The unintended consequence, however, was that the very people the measures were intended to help, ordinary households seeking stability, found themselves increasingly marginalized. Property prices in London and the South East surged, not driven by demand from families, but by investors chasing returns. Homes that might once have been attainable became aspirational targets, their value driven upward by capital flows rather than community need. The rental market followed the same pattern. Landlords, buoyed by rising property values and low borrowing costs, raised rents steadily, pricing out the very people who had once been able to enter these neighborhoods. First-time buyers faced an impossible calculus: work harder, save longer, or abandon the hope of owning in their preferred location. The human impact of these policies unfolded quietly but relentlessly. Families postponed long-held plans, young professionals delayed independent living, and many sought homes further from the centers of opportunity, creating longer commutes and fractured social networks. The pressure on wages, already constrained by broader economic stagnation, was compounded by rising housing costs, shaping spending habits, lifestyle choices, and long-term ambitions. Decades later, the legacy of cheap money continues to define Britain's housing landscape. Affordability remains elusive, access to property uneven, and social mobility constrained by structural barriers reinforced in the wake of post-crash policies. The story of this period is not just about numbers or interest rates, it is about a generation of Britons whose choices, stability, and aspirations were reshaped by financial decisions made in the boardrooms and central banks long before they took their first step on the property ladder. In essence, the policies intended to recover an economy left a lasting imprint on the very foundation of domestic life. Number 5. The widening wealth divide. The legacy of the 2008 crash in Britain is not just a story of financial systems and policy decisions, it is a story of people, and the widening gap between those who hold wealth and those who do not. In the immediate aftermath, the measures taken to stabilize the economy, from bailouts to ultra-low interest rates, created conditions that favored asset owners. Property values soared, stock markets rebounded, and those with existing investments saw their wealth grow steadily. For them, the crisis was a temporary storm. For everyone else, it was a turning point that reshaped the rules of economic participation. Middle and lower-income households, meanwhile, were left to navigate stagnant wages, rising costs, and growing debt burdens. The gap between what one earns and what one needs widened, forcing families to make choices they had never faced before: delay homeownership, reduce savings, or work longer hours to maintain a basic standard of living. Unlike the affluent, who could leverage cheap money and rising asset prices, these households experienced the full brunt of economic restructuring without the safety net of accumulated wealth. Over time, the divide became structural. Affluent neighborhoods prospered, attracting investment, services, and opportunities that reinforced their advantage. In contrast, struggling areas saw slower growth, fewer opportunities, and persistent economic pressure. Social mobility slowed, as the children of families who had been hit hardest faced higher barriers to education, property ownership, and career progression. The psychological impact is as profound as the financial. The perception of inequality shapes decisions, expectations, and even political alignment. The wealth gap informs debates over taxation, housing policy, and public services, coloring the way society understands fairness and opportunity. In the UK today, this divide is not just a statistic, it is a lived reality, a force that structures daily life, shapes communities, and defines the choices available to each generation. The crash may have begun in the financial sector, but its consequences ripple through every household, leaving an imprint that endures more than a decade later. Number 6. Job security and stagnant wages. The 2008 crash did more than destabilize banks and markets, it reshaped the very landscape of employment in the United Kingdom. In its wake, companies re-evaluated their approach to labor, prioritizing efficiency and risk management above growth and long-term security. Permanent positions gave way to temporary contracts, zero-hour arrangements, and lean staffing models designed to shield businesses from future shocks. Workers who had once expected steady advancement and predictable wages found themselves navigating uncertainty, their career trajectories slowed, and their financial planning complicated by a constant undercurrent of risk. Wage growth stagnated across sectors, even as living costs continued to rise. The sense of earning potential became decoupled from effort, creating an environment where hard work no longer guaranteed tangible progress. For many, the psychological impact proved heavier than the financial one. Employees internalized a sense of vulnerability, measuring every career decision against potential economic fallout. Ambitions were deferred. Promotions declined to cautious calculations rather than bold pursuits. Family decisions, buying a home, expanding a household, or pursuing further education, were reframed within a framework of caution, constrained by the lingering shadow of instability. This cautious labor market also altered how work itself is experienced. Job security became a privilege rather than a standard. Professional loyalty was tempered by the understanding that positions could evaporate overnight. The fear of unemployment permeated daily routines, shaping not only financial choices but also personal identity and well-being. In 2025, the labor market retains these structural fingerprints. Companies remain wary of overextending, while workers continue to balance ambition with prudence. The crash did not merely disrupt employment, it created a long-lasting cultural shift, embedding caution into the experience of work in Britain. In effect, the labor market became a reflection of the broader economic lesson: opportunity exists, but it is inseparable from risk, and security is no longer an expectation, it is a fragile, negotiated state that must be actively maintained. Number 7. Changing savings and investment habits. The 2008 crash did not merely reshape markets, it reshaped minds. Ordinary Britons, having witnessed the sudden collapse of institutions once thought unshakable, developed a heightened awareness of the fragility underlying financial systems. Confidence in long-term stability was no longer implicit, it had to be earned, monitored, and protected. For many, this awareness translated into a cautious approach to saving and investing. Emergency funds became a priority, a buffer against uncertainty, and low-risk financial products, savings accounts, government bonds, and cautious pensions, gained renewed significance as tools for stability rather than aggressive growth. Yet caution did not eliminate ambition. In parallel, a more adventurous segment of the population explored new avenues to grow wealth, whether through the stock market, property investment, or alternative assets. The drive was no longer blind optimism, it was informed risk, measured and deliberate, each decision weighted against potential consequences. People became more analytical about where they placed their money, how they diversified holdings, and how they prepared for the unexpected. This duality, prudence alongside calculated ambition, illustrates a profound cultural shift. The crisis did not only change banks or policies, it rewired the collective financial psyche. Britons learned that security is not guaranteed, and growth requires vigilance, patience, and awareness of systemic vulnerability. These lessons permeate daily life, the way households budget, the choices made about pensions or investments, the willingness to delay gratification in favor of long-term resilience. Even today, more than a decade later, the imprint remains. Decisions about money are rarely instinctive, they are informed by memory and experience, by the knowledge that economic stability can vanish with little warning. Number 8. Everyday life under the legacy of 2008. The legacy of 2008 is not confined to history books or financial charts, it lives in the routines and choices of everyday Britons. Each month, households balance rising bills against stagnant wages, making decisions that were once simple into careful calculations. Rent continues to consume a larger share of income, and debt, student loans, credit cards, personal borrowing, casts a quiet shadow over daily life. Even modest expenditures, from groceries to transport, are weighed with an awareness that financial stability is never guaranteed. The policies enacted in response to the crash, stricter lending rules, cautious banking practices, low-interest strategies, did stabilize markets, but they also created a framework that touches every decision. Families plan purchases with caution, saving for emergencies takes precedence over discretionary spending, and career moves are tempered by the knowledge that employment security can be fragile. These behaviors are not fleeting reactions, they are habits reinforced over years, shaping expectations, priorities, and even relationships. Generations that grew up during or after the crash internalized a set of unwritten rules: never assume the system will protect you, always prepare for volatility, and approach growth with vigilance. Financial choices are informed by this collective memory, from the way mortgages are approached to how retirement savings are structured. The psychological weight of the crash is as tangible as its economic impact. In essence, 2008 did more than disrupt the economy, it redefined the architecture of daily life. The systems it left behind guide spending, saving, and planning, silently structuring decisions that seem personal but are, in fact, deeply connected to the structural shifts born in that moment. To understand life in Britain today, one must understand how a single crisis reshaped the rhythms of ordinary living.